And welcome to another edition of the Nerdy Agent Podcast. We are back. This is Josh. Luke has been stranded in North Carolina by the Snownami. But we are psyched to be back on the microphone. I know some of you out there probably will going, hey, it's cool to see this because it's been a month or maybe even 2 months since we've recorded. A lot has changed in that time. Age, do you want to talk a little bit about why we had a little hiatus?
First off, do you remember those commercials when they first came out with the cell phones with multiple cameras on them?
Yeah.
I feel like that right now. Like, I don't know where I'm supposed to
We
look.
are getting hit hard in
Lots
this
of
new
cameras
new
going on in
podcast room,
here.
by the way.
Kyle is in the other room mixing this up for us. This is pretty crazy. So we officially merged and moved our entire team over from eXp Realty to Pemberton Real Estate. I think the fastest growing independent brokerage here in Minnesota. We've hit the ground running. I think we've surpassed Q1 as an office now versus 2025. So yeah, I was surprised that happened. I thought we'd have a little slowdown.
Yeah, it was pretty exciting. So the story we kind of tell is we've always been really close with the Pembership leadership team. Parker, who is the CEO and co-founder, he brought AJ over to EXP when he was there. They've been buddies for a long time. And so as they've continued to grow and spun off their brokerage in September, it made sense to tap into a lot of the amazing things that they're doing over there. So our agents now have the same access to our team in our office, but now have the ability to tie into a lot of the really cool marketing and materials that they're doing at the Pemberton side. Just continuing to try to give agents more and more things to be successful with.
Yeah, so pretty exciting.
So
we will be doing this podcast now once a month, the third Tuesday of the month, probably released the, fourth Monday of the month or
probably something like that. Our goal is to make them maybe a little bit longer than you're used to. So instead of the 15-minute heavy hitters, they might be more like half an hour now. We'll make sure Luke is here because everyone needs Luke in their life. And you kind of come at you with some of the same stuff that we were getting to you before. Before we get going, though, I have to joke. When I got to it's wet outside right now, right? My jacket was on the floor in our vestibule this morning. And
vestibule?
We call it the vestibule. That little entry area in our house.
The foyer?
The foyer, sure. I call it I like the vestibule. And I, in a rush yesterday, took my jacket off. Well, of course, my kids set all their snow stuff there, and we have the heated floors, so it kind of like turned into puddles. And so I got to my closing this morning, and my jacket had been wet on the inside the entire way there. And I looked down, and my entire pants area, right in the worst spot, was just a puddle. And I was like, oh, I look terrible, guys, but we're drying up now. Hopefully at some point today when I interact with clients, I won't look like I've got a wet spot in my pants.
It's always tough this time of year. We've got heated floors in our garage, so it's just puddles and puddles and puddles.
But in your vestibule, do you have heated floors?
No. I will say, you have that room that you added on to the back that you probably call, what do you call that room?
The Kapua Suite?
Nope. This is what you should call it. You should call it the conservatory.
The conservatory.
I love the conservatory.
That room is, the joke is it's called the Kapua Suite because if you've seen Forgetting Sarah Marshall,
I have.
He goes and they don't have no rooms for him, but they only have one room left, and it's a very fancy, unnecessary room that no one ever stays in. And so when we built that room, I was like, we don't even need this space, but it's like this really fun, fancy room that we built.
Yeah.
And so I'm like, we'll call it the Kapua Suite.
The Kapua Suite.
So that's what he said.
Nice.
He's talking. He's like, I'm staying in the Kapua Suite.
You got your hand motion.
Yeah. So we've named every room in our house. We've got the lodge. We've got the vestibule. Now we've got the Kapua Suite. Anyways, you guys probably want to get into the nuts and bolts of what has transpired since we last chatted. Interest rates and some changes in the world are probably the biggest things that we should talk about. We went through a period of time where the rates were around where they are today. We're sitting at roughly 6.25 to 6.5 right now, depending on who you talk to, but that's kind of like your median average range. Did drop down under 6 for a little bit, like we had kind of been predicting it would, but then there were some changes that happened. So, H, do you want to give a little rundown of what has transpired there?
Yeah. I mean, I think we didn't talk about Venezuela when we were on last time.
We maybe even haven't gotten to Venezuela yet.
Yeah.
We got a lot to catch up on.
Yeah. So the United States kidnapped the president of Venezuela, which was something. That one actually had a positive market impact because it presumably opened up a lot of opportunity for oil Venezuela is a struggling country. They have been for quite some time. If you want to look up some fun statistics, you should Google inflation in Venezuela. They had like 1,000,000% inflation.
If you lived in Venezuela, it's not fun. But if you're an economics nerd, it's a very interesting case study.
Exactly. But they've been a very impoverished country for quite some time. And from all accounts, very inefficient with the way that they produce their oil. Capturing the president, Trump touted as this great thing, and that we're going to go in and we're going to produce more oil, and it's going to be better for everybody, including the people in Venezuela. Yet to be seen if that's going to happen. But when things like that happen, and we have more access to oil, first and foremost, you're going to see the yields start to come down, the rates start to come down. So to Josh's point, we saw rates dip under 6% for like a day or two.
Because of that I word, if you're listening, you can say it with me. It's inflation.
Yeah. So if there's more oil, it makes up a large portion of consumer goods and gasoline and fuel and all sorts of things. That if the price of the per barrel price comes down because there's more supply to meet the demand, that will lead to lower inflation. That will lead to lower yields. It'll lead to lower mortgage interest rates. Now, I think Trump wanted Iran to kind of play out the same way. And it certainly did not. So killed the supreme leader of Iran next. Yep, these are news headlines that are happening in 2026. And what's happened now is Iran has effectively blocked. There's a strait through the Mediterranean Sea that dumps into the ocean. I think like 30 to 40% of the world's oil barrels move through that strait every day. It's pretty much not being used right now. I believe the U.S. said they are trying to help even some Iranian tankers through there, but I believe last night there was another bombing. I know the UAE got bombed on one of their gas locations, and I think a tanker got bombed overnight going through the strait as well. So because of that, again, same topic, different direction, right? So now we have less supply of oil to meet the demand. That put the oil futures at over $100 a barrel, which is kind of a tenuous spot for those prices to be. That led to yields going up really dramatically, and like Josh said, rates got up to like almost 6.5 within like 3 days. So we've kind of taken a round trip, and we're pretty much close to back to where we were before all of these hostile takeovers and killings of supreme leaders. So it's a matter of how quick we can resolve the conflict at this point.
Yeah, I'm sure anyone who's been listening to this in the past understands the logic, kind of how this all ties together. But we've talked about it a ton of times on this podcast. But just to kind of clarify, if oil prices go up because there is less oil available to people, right? You're seeing it at the gas pumps, you're seeing it everywhere. That's going to lead to inflation. Inflation is something that obviously is a big deal to consumers from an economic standpoint. They only have so much money if the price of gas goes up super high. So therefore, rates on the Fed interest rate side, the Fed funds rate, are less likely to come down, which means your 10-year and 5-year yields are less likely to come down or will not move as quickly, and therefore your 30-year mortgage rates will actually go in the same direction.
And when I was talking with a buddy, actually my accountant the other day, and he said that like spiked oil prices precede like every recession that's ever happened, pretty much. So, and I don't know that every time
they predicted 12 of the last 3 recessions.
I was going to say, I don't know if every time the oil prices spike that there's a recession, but they have preceded recessions, so they're a pretty good indicator of something bad going on, because they cause higher prices across a broad spectrum of goods and services. So, it'll be interesting to see how that plays out. I think it's really just tracking the news on how that's all going. I don't feel like the United States, the White House right now, is probably likely to back down anytime soon. They haven't done much backing down.
No indications.
No. And Iran's got a very strong fleet of military drones. They overproduce very cheap, like kamikaze style drones. I don't know if you've seen the videos on that.
It's wild.
It's wild. They have like thousands and thousands of them
flying
just
into
underground, and and they're like, in the 5 figures to produce, whereas the stuff that we're flying like actual planes with no unmanned planes, they're like billions, but they've got these cheaper drones, and they just fly them into buildings with bombs on them and stuff. So they seem pretty prepared for a long fight here. That said, their top officials are getting picked off like left and right, because Israel just knocked off their top military official last night. So there's a lot of like wild high level assassination type stuff going on with military leaders in the Middle East right now. The guy that died last night, I think, was the one who had vowed he was going to kill Netanyahu. So they're all out for blood.
The temperature is high. Neither side seems like they're going to do what is being asked of them by the other side and come to some sort of a conclusion or peace. We've seen the impact, obviously, of war in Russia and Ukraine. We've seen a lot of this stuff kind of happening everywhere, obviously, with Israel's approach to Gaza, too. None of it is, I mean, however you feel politically, none of it is obviously good, but none of it's good for real estate either in terms of how it kind of flows through.
Just unstable, right? I mean, like as soon as there's instability across the world, that's going to lead to just kind of like I said, I mean, rates went down almost half of a point and then back up half of a point and now down.
They were actually looking pretty darn good.
They were. And so when that's happening, I'm doing a market update on Thursday. It was I could pull up some of these fascinating charts, but super interesting to see. Shout out to Gemini for all the charts I was able to obtain. But, the monthly mortgage payment on a $100,000 loan since 2015, right?
Yeah.
2015, January 1st, at 3.95%, the payment on that was $474.54. In 2021, it was $410.89 at 2.8%. Now it's at 630.75. So it's up about 50%.
Yep.
Every $100,000. Well, then you go, okay, what about the delta if you include the fact that homes have appreciated?
Yep.
The payment at 410 or 474 from 2015 is now $1,207. So I said, well, why don't you do that same thing, but do it and show me the wage growth that's in there too.
Yep. Wage
growth is at 39.6% over the last decade. Payment growth is 154.6.
Yep.
So you have pretty much double the payment. And some wild stats like what was the one? As of January 2024, the mortgage burden is roughly 1.82 times what it was in 2015. In other words, for every dollar of income, the monthly mortgage payment now takes up to 82% more of your earnings than it did 10 years ago for the equivalent property.
Yep.
To restore 2015 level affordability at today's home prices, mortgage rates would need to drop to approximately, guess. So
2.5.
1.95%.
Jeez.
Which isn't even a possible rate.
Yeah.
Price correction. If interest rates stay at 6%, home prices would need to drop by approximately 40% globally to reset the payment to a normal level.
Define normal level, 2015.
Yeah.
I guess 2015 made about normal.
Inflation adjusted 2015.
Yeah.
Slow burn. If prices and rates stay exactly where they're at today, it would take roughly 12 to 15 years of consistent 4% annual wage growth with zero home price appreciation for incomes to finally catch up to the current cost of housing.
Yeah, housing is just becoming a larger portion of everyone's budget. And it has had to be because your alternatives are still high. You've seen rent growth not happen that same way. We've talked about that. Mm-hmm. But the purchase growth has been enormous.
Yep.
Now, as we head into 2026, we talked a little bit about other things that have happened since this. They've announced the new Fed chair. That's going to happen in May, so it's coming pretty soon.
Nominee, did they approve?
I don't know if he's been approved yet. Actually, I don't.
Warsh,
not Walsh. Warsh.
Or not Warsh if you're in Tennessee.
Yeah. You should tell that story. Yeah, I'll wait to this. They nominated him, but he has not been approved yet. I think my understanding is that he's not that controversial.
I don't think he is, no.
And he's less of a loyalist than kind of people were expecting. I think going into it, though, the expectation on the front end was that you'd see, okay, you have more of a loyalist. Rates are definitely going to get pushed down. The Fed's going to get more aggressive with cutting rates. Now, and they had kind of predicted in the markets that was going to happen. Now we're seeing a lot more of those predictions going, instead of 6 rate cuts next year, we're going to see maybe 1 because the war and the inflation and all that is going to weigh in a lot on how the Fed is going to operate. So I do anticipate now, as someone who was saying, I don't think anything will happen in 2025, but I think 2026 we'll see rate cuts. I didn't foresee a war on my bingo card, and that's kind of changed my crystal ball a little bit on this. But I don't know what you think about that and kind of thought process.
I think it's going to be a very similar year to 2025. Rates will stay hovering between 5.75 and 6.5 probably.
Yep. Unless this oil thing gets out of control.
Exactly, and they go to 8% if that happens.
Yep.
I I think if the White House really wants to make housing more affordable, there was an article that came out. You said a bill that got introduced that would prevent large corporations from buying single family homes.
It was one of many things, but yes, was on that.
Which is that's a good policy that it just keeps corporate out of single family housing. It's not a bad thing in my opinion.
I would agree.
The buying of mortgage-backed securities, also a great idea. There are some levers the government and the Fed can pull that can directly impact one market rather than just all markets.
Yep.
And I think if they want to make housing more affordable, those are the kinds of things that they probably should be focusing on.
What's ironic about funny about the bill is it sounds like it's dead. It's dead. It passed the Senate like almost unanimously, like 89 to 11. So they like all were in favor. The House apparently is opposed to it. And the biggest provision that the House is opposed to, it sounds like, is the ban on institutional investors. So I think the president had the idea and is the one pushing the ban on institutional investors, which is weird to me because you would think that that would fit kind of his typical policy action, which is support more wealthy folks. But I think the far right in the House is opposed to this. Like the Freedom Caucus people are opposed to that, and they're fighting against it. So I'm not entirely sure where that one's going to go, but that was really interesting. I mean, if you own over 350 single-family homes, you're not allowed to purchase additional properties.
It's like
no brainer.
And
why would you not allow that to happen?
And what are you harming by not allowing that to happen? They're going to go invest in something else. Maybe their return's not quite as good as they can get on a house.
I mean, ironically, right now, I think they'll probably just be selling them off with the way that single-family residential is going anyways.
Right.
So I'm guessing you've already seen market, more like capitalistic free market behaviors go to a point where they're not that good of an investment anymore. So I do think we're going to see that spin off, which will hopefully help with supply. But banning that seems like a no-brainer. Cutting red tape and regulatory reform, so minimizing some regulatory things. Modernizing manufactured housing. I like all of these ideas. Expanding eligibility to include workforce housing for those that earn too much for traditional subsidies but are still priced out. Getting some block grants in place. Repurposing vacant buildings. Because all the commercial real estate has come way down.
Mm-hmm.
Minneapolis got hit really hard there. Support for rural and veteran housing. And then pattern books, so a set of pre-approved architectural designs for duplexes, ADUs, and townhomes to help builders move more quickly.
Oh, so like you just submit the plan, it's done, you're good.
You wouldn't even have to submit the plan. You could take one of the plans that they've already built.
But you have to, like, when you go in for permit, you don't have to like redraw something.
Automatically approved. Yeah,
that's brilliant.
I like all these ideas. So I don't know if this one's going to be something that ends up being beneficial, but I think this is more aimed at, I feel like, the housing stock, which is a major problem right now, where there's not enough inventory, which is what's keeping prices so high. That's kind of causing all the things you're talking about.
But a lot of that like seems like
happen.
it's attacking the fact that the middle class is disappearing and they can't own homes, right? And so
Yes.
that's a really good thing that they can try and help those people. And there's also a bunch of lower income provisions in there,
Yes.
and even in between, like the one in between
and
that says,
rural and veteran. And,
yeah, but like the one in between low income and middle income is like you earn too much to get Section 8 housing or to qualify for this thing.
Yep.
But we're still going to help you because you're at a point where you earn too much for that, but you don't earn enough for this. So
well, because to your point, people that earned that much used to be able to afford a house.
Exactly.
And now they can't because the market has changed so drastically. So that's really interesting things happening there. The other thing that from a crystal ball standpoint, we should probably talk about, because you're already talking about the inflation and all the different impacts from that, but the wage growth piece with everything happening with AI is also a really interesting thing to think about in terms of unemployment, what's happening there, and where that might be going in the next year, 2 years, 3 years. There was an article I read this morning, Anthropic's talking about concerns around the white-collar workers and their impact to the economy as employees. There was a great article where someone wrote about, like, fast forward into 2028. I sent this to you and Luke.
I read it.
And it was like, here's what's happened. They like published the third quarter of 2028 and talked about all the things that have happened over the last 2 years as AI has gotten introduced into different spots in the workforce. But there are some serious concerns there that as AI expands its capabilities, how will that impact jobs? How will that impact wage growth? How will that impact all of those things?
It's super scary, super fascinating. This is like, I took very advanced like game theory classes in college, and this is exactly what this is.
Yep.
So it's the example they give in the article is a SaaS company, so software as service. Let's say you're SPS Commerce, you're a logistics company.
Salesforce.com.
There you go. Yep. And then let's say you're Target.
Yep.
And you currently run on Salesforce, and it costs you $5 million a year to run your Salesforce. But you have 50 internal software engineers that understand AI and can just basically create a Salesforce internally.
Yep.
So they go and they create the Salesforce internally, and that saves them the $5 million less whatever expense it costs to run that platform.
Yep.
And now Salesforce has less money, so they either have to lay people off, or they lay people off and make their platform more AI, or they reduce their margin and make it cheaper.
All of the above.
None of which is good for the workforce.
Well, because then they reduce their platform and they reduce their pricing, which then reduces their income.
And then they have less workers.
And then because they have less income, they have to fire workers in order to make that go. And then they invest in AI to make their platform better, which then continues this cycle of people investing in AI and firing workers.
It's the same thing as the wage price spiral, where if inflation runs high, it costs people more money to live. So they go to their employer and say, I can't afford to live on this salary. I need to get a raise. The employer gives them a raise. Then the employer needs to charge more money for the goods and services that they sell because they're paying more money out to their employees. And then that makes the inflation go up, and then the thing goes round and round and round.
What's scary about this is that there's a subset of people who spend most of the money in the economy. And so the economic impact of what we're talking about is the big concern, where you're going, okay, with blue collar workers historically, when it was like, we've outsourced jobs to India, there was less impact to the amount of spending happening in the economy because the employees who were losing their jobs were not spending as much as the employees who are now at risk of losing their jobs. So the efficiency that AI can create is a really positive thing because it makes the cost side theoretically cheaper. But if it ultimately makes white collar and people who are making higher incomes more expendable from an employer standpoint, and they get fired, then there's just less money in the economy to spend on stuff.
There's less velocity of the money.
Or both.
There's the same amount of money exists.
Maybe.
The money didn't disappear. But
well, the employers are probably making less money, and that's why they're firing workers, which then is spiraling to make less money, which then firing
it's
more
just
workers.
spreading. The money's just spreading out is what's happening.
But the people don't have the money to spend the money to
there's less velocity.
boost the economy.
Correct.
So it kind of grinds everything down, and it creates a downward spiral.
The more people you get that are billionaires, the less velocity of money you're going to have because they
can only spend so much.
They can't spend that much money. Whereas if you took their money and spread it across 100,000 people, all the money would get spent.
Yes.
And it would make the economy do better. But you're right that it's this funny game where it's always been we want to compete the most to be the most efficient. But if everybody's able to do that in a perfect world, we're now at like textbook economics, which tells you like it leads to destruction.
Yep.
And it's kind of crazy if we don't all like have some humanity and decide to support ourselves, then we all will lose in the end, kind of.
It's not to go off topic of real estate here, but it is also, it's kind of in a weird way like the perfect human experiment of like, are we inherently okay, like good people, or are we inherently not okay, good people?
Just compete for myself, yeah.
If it's all about yourself, then this could end up very, very badly, and I'm a little afraid that's the direction that we're heading.
That's not looking good.
Now, this is not AJ and I trying to get the microphone for the first time in multiple months and be like, everything's falling apart, the sky is falling, freak out. That's not the goal. I think it's important that you guys know the real estate market is still moving here in Minnesota. People are still buying and selling houses. But do be thoughtful about a lot of these things because you do want to understand where the economy is heading. And if there are some negative signs, that will impact us as real estate agents.
Totally.
And be thoughtful about how you can best support and talk to your clients. Anything else crystal ballish today?
No,
Have we covered it all?
That was great.
All right. Well, leave us some comments. Let us know what you thought about our first episode back. If there's certain things on that list that you want us to dig into in more detail, we can do that. We'll be back with more stuff next month, but we're psyched to be with you again. We're really excited to be here with the Pemberton crew, and we'll be coming back with you next month on the Nerdy Agent Podcast. As always, remember, be better.